Hey, welcome to this. This is Curtis May, and welcome to this intro to private family banking, infinite banking, and at our firm we call it the private reserve strategy. And so I'm going to give you a kind of a high level overview. And so at the end of this, if you want to know more, then you can reach out. Hi, this is Curtis May, and welcome to this introduction of private family banking. And what I'm going to do today is go over a high level overview of the strategy. And one of the things at our firm, we talk about principles, strategy, and then what we call tactics. So we do something called the five principles of personal finance. Well, principle number one is save, right? And so saving 15, 20% of your gross income or more. Then there's strategy. So what I'm going to do is now I'm going to teach you a strategy of what to do with your savings, and then the tactic that we specialize in, you're going to see a little bit later, of the tool that you use to implement the strategy that we're about to share. So let's talk about that. So let's talk about, what is the goal? So we help people create and use their own private family bank at Practical Wealth so that you can learn to get money to move towards you instead of away from you, how to get interest moving towards you and instead of away from you. Most people's money interest is moving away from them, right? And you can't win that way. And so what happens is, think about this. What keeps you up at night? Is it profit in your business? Is it taxes? Is it revenue of your business? Is it growth of your money? Is it the economy? Does that keep you up at night? Is it marketing if you're in business? Are your kids keeping you up at night? Retirement, investments, college coming up, inflation, debt is a biggie, right? And healthcare, are those things keeping you up at night? Well, what's the solution? Is the solution a better advisor? Is it a better plan? More money? We're going to explore that. This is our Buckminster Fuller, and one of the things he says is, I spent my whole life trying to unlearn things that I found not to be true. One of the questions that we ask, if what you thought to be true turned out not to be true, when would you like to know? And so one of the principles, we teach something called prosperity economics. Well, the very first principle is think. Think from a prosperous mindset. Thomas Edison says that 5% of the people think, 10% of the people think they think, and the other 85% would rather die than think. That's funny, right? And so what I want to ask you is, do you operate out of imagination or out of memory? To see, if you're operating out of memory, you're still holding on to the past, but the world changes too fast to do that. So let's talk about private family banking. What is it? Private family banking is really simple, okay? It's the creation and utilization of a pool of money that is controlled by a private individual. So it's not a product or anything. It is, you're creating a pool of capital that you can use, that can move at costs, that to meet some needs you have. And so the person who puts the money in owns the bank, and the one who owns the bank receives the profits from the bank. So ask yourself, would you like to, if it was possible for you to create a mechanism that allows you to be the bank, is that something that you'd want to do? And so banking is the most important business in the world. See, every transaction requires money to flow from one party to another. That money must flow from a pool of money somewhere. And banking is all about controlling the pool of money, capital, that can flow at cost to meet some need. And so one of the things you've got to understand is who are the players in the play. So when you look at the banking business, you've got three parts. You've got the saver, you've got the bank, place where the money is stored, and you have the borrower. So where people saved in what? Where do people store cash is the question I like to ask people. CDs, savings accounts, is it Roth IRAs, money markets, IRAs, mutual funds? So I would argue if you're doing mutual funds, IRAs, you're not really saving, you're investing. I'm gonna fix this slide. And so what happens is now you put it in the bank, and then the bank loans it to the borrower, right? For leases, for credit cards, for mortgages, for student loans, for business loans, auto loans, right? And so ask yourself, are you a saver or are you a borrower? The truth is you're usually both. And what happens is, let's think about this. So part of the strategy, and what you're going to see is not about, see, too many people are chasing returns, and people will show you kind of a variation on this system, and you think it's about the rate of returns, but what it is not about that. And so what we're going to do is mimic the business strategy of one of the most successful institutions in the world, the banking industry. So let's look at their business model. How do banks make money? So let's take Bank of America, right? So in Bank of America, you've got the saver, you've got the banker, right? Bank of America, Citizens, whatever. You've got the borrower. So Bank of America, as of this slide, this is from the Borrower Report 2017, they've had 909 billion with a B deposits. They paid 3.1 billion in interest. Interest is what they're paying to rent your money. Okay. So now they're paying you, 3 billion or out to us, paid to hold that money, but then they loan it out to the borrower. So, but you can't, they're just not giving it to you because you're a nice guy or gal. They want your credit report. They're going to charge you fees. You got to have a job. You got to apply. And so they've made 49.9 billion in interest paid to Bank of America. So they paid us 3.1 and they earn $4.9 billion. Okay. So that's an average ROI on our savings of 0.34%. And even at earning, see, 5.5%. So people say, well, 5.5%, that's not really that impressive. Yes, it is actually, because that's a 16-to-1 ratio, and that is a spread of 1,600%. Are you earning 1,600% on your money? Then how about maybe we should learn how to do what they do instead of stop doing what they tell us to do? See, think about this. Here are methods of finance. How do we buy stuff? So I always tell people there's three types of people in the world. There's the debtor, the saver, and the wealth creator. So if you're a debtor, this is what I call the zero line, right? And when you need a big ticket item and you don't have the money, you have to go into debt, and then you pay it back, and then you go back into more debt, and then you pay it back, and you always are working your way back to zero. The other way is to pay cash. So in order to pay cash, don't you have to first save it, right? So for most people, saving is just delayed spending, and then they save and then they take it out. They save, they take it out, but you end up right back where you start out from at the zero line. And so the third person is the value creator, or I call the wealth creator, using private family banking. So you need to save, let me go back there, and you need to put money somewhere, but you want to put it somewhere that you can use it, but it can, what if you can put it somewhere you could use it, but it continue to go forward every year. So every year you were better off than you were the year before. What if that was the foundation of your personal economy, where you had your blue line going up every year underneath everything else you were doing? Wouldn't that be great? Well, keep listening. So what happens is we teach something called prosperity economics. So there's a couple things. One of the things is that we teach just two schools of thought. There's the accumulation theory and the velocity method, right? And so the accumulation theory, you hear things like compound interest, growth is taxable, high risk equals high return, own term or buy term investor difference, pay cash or use debt or get out of debt, right? Use non-deductible toxic debt. So they teach you to, go buy cars and houses, but it's not deductible and it costs you money. You work for money. The first chapter in Rich Dad Poor Dad is rich people don't work for money. You rent the banking function. See, the problem is we don't own the banking function. We rent the banking function to Bank of America, to Wells Fargo. And you're taught to accumulate, build balanced portfolios, portfolio rebalancing, indexing with the S&P. But wealth creators don't focus on any of that stuff. They focus on velocity, how many times, which is the economic principle that talks about how many times you can turn money over. It's not about interest rates, right? They put their money where they can get tax-free growth. They don't want returns. They want safety. They want guarantees. I call it the economic value of certainty, right? They own dividend whole life instead of running term insurance. And this strategy is based on, we're not going to go too deep into that in this call, but for the private reserve, we use properly structured dividend paying whole life as a place to store cash. You notice I didn't say index universal life because that doesn't work for the strategy that we're talking about, contrary to what you may have heard. And so we use OPM, other people's money, and good debt. We buy capital assets. See, wealth creators use debt as money to buy assets that produce cash flow. They buy capital assets that equal cash flow, a rental property, a business, right? Money works for you. Instead of you working for money, you own the banking function, which is the focus of this talk. And your dollars, instead of accumulating, your dollars are there to buy more assets and fuel wealth creation through how? Through creating velocity. And so we say, would you like to be a wealth creator? Because this is what most people do. See, most people earn money, then they get taxed, and then they have overhead for their business, or they've got mortgage, car, credit, their living expenses, and then they try to save what's left over to go to their family. So we want to teach you how to put yourself in front of that line. Now, the strategy, let's talk about the tactics we use, and we'll get you some more information on the specifics. So don't go crazy, because I'm going to show you this is what successful people do, and it's not new. What I'm about to share with you, I'm going to show you, it's just new to you. Okay, and like I said at the beginning, it's something you thought to be true turned out not to be true. When would be a good time to find out? So why life insurance? See, you get a death benefit, because I don't know anybody, unless you know something I don't know, nobody gets out of here alive, so why not make that sure that's a wealth creating event? You build up cash value, which is savings, and then you can use that cash value as collateral so that you can use it to create wealth. So life insurance cash values of your greatest source of what we like to call collateral. Collateral capacity is what we call savings building collateral capacity, meaning that money that you have saved that you can use as collateral to do other stuff, but still keep your money at work. So who does this, right? So there's 3,800 U.S. banks are the biggest purchasers of cash value life insurance. So one of the biggest ones being Bank of America. They own, as of the time of this article, $17.3 billion, okay, of not death benefit, of cash values, followed by Wells and Wachovia, which is Wells Fargo. This is before this article came out. They merged Citizens, and it's called BOLI, Bank-Owned Life Insurance. So this is where they store what we call their Tier 1 capital, right? Who else does this? Walt Disney. Nobody heard of a clean amusement park, and Walt Disney wanted to, he needed $75,000 to do the feasibility study to create Disneyland in California in 1952. Guess where he got $75,000? He borrowed against his personally owned whole life insurance policy, okay? Comcast. General Electric. General Electric had a life insurance policy. They were paying a pension out of for Jack Welch. Yeah, Jack Welch. And when he died, they were the beneficiary of his life insurance policy, and that money came back into the company. Walmart, Sam's Club, Harley Davidson, McDonald's, Ray Kroc, and insurance companies were very responsible in loaning money to McDonald's in the early 60s to get it off the ground. Johnson & Johnson, the Pampered Chef, Doris Christopher, the Pampered Chef, home ec teacher borrowed $3,000 or $4,000 against her life insurance to build a direct sales company called the Pampered Chef, and so built that company up, direct sales company, kind of like Tupperware, and sold it to Warren Buffett for like $20 million. See, this is how money is made. There's no money in a product, right? And so Foster Farms, Macy's, JCPenney, Verizon, they all use it. So Ben Bernanke has 80% of his money with life insurance companies. He's a former Fed chair. Most of that in something called an annuity. John McCain funded his presidential campaign with a life insurance policy loan. FDR owns $562,000 of cash value in his life insurance. Present value of that is $7 million. Walt Disney borrowed against, we talked about this, his life insurance. JCPenney, to keep, in the stock market crash, he borrowed against his insurance company to make payroll against his policy to keep the pump. The Rothschilds, the Kennedys, Ray Kroc, Jim Harbaugh took part of his $14 million pay package, and that goes to life insurance. Brian Roberts of Comcast, $200 million retirement package. Same thing as Jim Harbaugh. It's called a split dollar. And then they play with, it's called what's called a non-qualified plan. And, he gets access to capital, and then the company gets back all the money they gave him when they passed away because of the death benefit. So think about, as you see this, could these things work for me? We talked about Doris Christopher and Jack Welch, right? And so let's talk about banking on a community level. So banking is a process. It's not a product, right? So there's only one pool of money. That pool is either controlled by banks, life insurance companies, or Wall Street. And so what we talk about is we create what we call maximum efficient contracts, where we pay premiums into policies into that pool of money. But when you use insurance, you can access the money. So you can use it for cars and then repay back your pool of money. Mortgages, or a lot of times we use, our clients use it for down payments. Credit cards to pay off debt and then recapture that money. And so all about the process of banking. But see, because what you've done is, if you can create a pool of money you control to finance your needs, you can begin to create interest coming back to you as opposed to you paying it out. So let's talk about your family bank. This is the picture of the structure. So you earn money, you save money, some of it flowing through permanent insurance. You've got your bank. So you borrow against insurance. The bank is really a checking account. That's a longer story. We'll explain it later. But what happens is, so now you've got things that you need capital to finance, right? Your company, investing opportunities that come up. You want a vacation home. You want a family vacation. You've got tuition. You need a car. You need home improvements. All these are all things that we use our bank for. And so let's go back to the banking model. It's the saver. So you're saving money using permanent insurance. Well, why would I do that? Well, what do you get on your savings now? I showed you, you're paying 0.34%. Cash value, and insurance pays 4%. So as a savings plan, and it has a death benefit, it still works better because it's not an investment. It is a saving strategy to store cash. Okay. And so now you've got the banker and you've got the borrower, right? The stuff that you want to do. And so the insurance company is the depository, but so you obviously own your earnings. You own the policies. They don't all have to be on you. Because we use mutual companies, you're part owner of the company. It's where the dividends come from. You own your banking system, and you can own your company, your investments, the opportunity, your vacation home. So you're doing everything. And see, here's the thing, Nelson Nash, which is part of the assignment of this, is to pick up the book, Becoming Your Own Banker. Everyone should have two businesses, the one that gives them a paycheck and the banking business, and to finance what you need to do. So this is the May crew, right? And so what we do, we've got our policies, we've got the May Family Bank, and we've got our business. So you see, once you understand the players in the play, once you know what's going on, you'll know what to do. So you need to control of the entities and control your money, okay? And so we call it, is another one of my favorite books on the top, is called the Money for Life model. So in that model, it's really simple. You want to get money. So you got to work it, earn it, inherit it, sell stuff, right? Invent something maybe, but then you have to bank it, save it, but bank it somewhere to allow you to act as your own bank, meaning a pool of capital that you can control, that you're going to borrow from, or really the correct word is against your bank or against your policy. You're going to spend it, what you need to buy the things you need and want. So spend, let's break down spend. Spend means, what do you spend it on? Major capital purchases, anything you can't pay for within cash flow, or investments. You know, we've had clients use it for down payments for rental properties or to buy ATM machines, and then they repay their bank with both principal and interest on that borrowed money. Okay, and so that's the banking system. So here's the thing. In conclusion, are you interested? So this is a really a short overview, but if you're interested in starting your family bank, then reach out to us at Practical Wealth Advisors. You'll see the links to get more information. One of the things that we will gift you is a book by Kim Butler called Live Your Life Insurance, and we can set up a brief consultation, and we'll go over the more details about the product and the strategy and how to properly set it up. So anyway, hopefully this was helpful. Go out there and make it a great day. Thanks for listening.